Latin America supplies roughly 50% of the global demand for copper and lithium, the raw materials driving the energy transition. To meet the projected needs of electric vehicles and grid-scale storage, the supply chain requires a constant influx of newly discovered reserves. That discovery process relies heavily on junior mining companies. Unlike major producers with established cash-flowing operations, a junior miner's sole mandate is early-stage geological exploration. They survey land, drill core samples, and prove that a viable mineral deposit actually exists. This creates a precarious financial window, known in the industry as the Valley of Death. During this exploration phase, a junior miner generates zero operational revenue, yet requires immense capital to fund continuous drilling programs and complex geological surveys. Traditional financial institutions view this pre-revenue phase as too risky. Banks will rarely issue debt without a proven, cash-flowing asset to use as collateral. Even alternative financing models like streaming agreements, where investors buy future production at a discount, are difficult to secure without defined reserves. Without access to bank loans or structured offtake agreements, these enterprises face a severe capital shortage. When exploration companies cannot fund their drilling, new deposits remain undiscovered, creating a structural bottleneck that threatens the downstream supply of critical minerals. To survive the Valley of Death, junior miners historically turn to public equity markets, attempting to list on legacy exchanges like Canada's TSX Venture Exchange. An initial public offering offers liquidity, but the process requires hiring investment banks, legal counsel, and auditors to prepare prospectuses and regulatory filings. These structuring fees, combined with underwriter commissions, consume a massive percentage of the capital the company is attempting to raise. Regional options present their own hurdles. Seeking capital through local hubs, like issuing shares on the Colombian Stock Exchange, for example, or structuring traditional trust mechanisms known as fideicomisos, still requires navigating a dense and complex web of local financial intermediaries. Across all these legacy routes, the core friction stems from the due diligence process itself. Evaluating a mine requires reviewing hundreds of pages of technical reports and geological data, which are often shared as static PDFs. This reliance on manual, paper-based verification slows down audits and creates informational opacity for potential investors. The infrastructure of traditional capital markets was built for large, established corporations. Its reliance on manual intermediaries and high upfront fees makes it structurally misaligned with the speed and cost efficiency an early-stage mining enterprise needs to survive. To solve this capital bottleneck, platforms like PoseidonX are re-engineering financial market infrastructure from the ground up. The process begins at the physical mine site, where raw geological data must be digitized before it can be monetized. Mining exploration is governed by strict regulatory frameworks. For example, Canada's NI 43-101 reports dictate exactly how scientific and technical information concerning a mineral project must be disclosed, requiring certification by a recognized qualified person. Instead of a team of analysts spending weeks reviewing these compliance reports, Agentic AI and robotic process automation are deployed. These systems instantly ingest the unstructured technical data, parse the geological findings, and cross-reference the required certifications. The AI then translates this information into XBRL, or Extensible Business Reporting Language. This is a globally recognized machine-readable format that standardizes complex corporate finance data. By automating the structuring process, the system removes manual auditing bottlenecks. What used to be static, unsearchable paper documents are converted into real-time, instantly verifiable machine data, ready for market execution. Structuring the data is only the first step. To build investor confidence without relying on traditional banking intermediaries, that data must be cryptographically secured to prevent tampering. This is achieved using distributed ledger technology. Networks like Solana or the Canton Network serve as a decentralized settlement layer, providing an immutable record of the mine's data and ownership structure. To connect the physical reality of the mine to the digital ledger, the architecture relies on an oracle. An oracle is a cryptographic bridge. It continuously feeds verified, real-world information, such as reserve updates from the NI 43-101 reports, operational metrics, and compliance statuses, directly onto the blockchain. This mechanism guarantees strict parity between the physical rock in the ground and the digital ledger. If a drilling parameter changes at the site, the oracle updates the network, eliminating the informational opacity that plagues legacy markets. With the asset's technical and financial data constantly verified and anchored on-chain, the need for expensive manual underwriting by investment banks becomes obsolete. Smart contracts now handle the transaction logic. These self-executing programs automatically enforce corporate governance rules, verify accredited investor status, and ensure regulatory compliance without human intervention. The final output of this automated architecture is a security token offering, or STO. The smart contracts package the Oracle-verified data and issue circulating digital tokens that legally represent equity or debt in the mining project. Every issued token is governed by what PoseidonX calls the T3 protocol: traceability of the physical asset, transparency of the standardized XBRL data, and trust enforced by the cryptographic oracle. By replacing manual intermediaries with agentic AI and smart contracts, solutions like the Ramp 0 program allow small and medium enterprises to access public capital markets. They can execute the equivalent of an IPO for a fraction of the traditional upfront cost. Zooming out from the software stack, we can see how this architecture actively reroutes the global financial system. High-speed lines of liquidity can now flow directly from major financial hubs to localized mining projects in Latin America. The fragmented web of regional exchange bottlenecks, correspondent banks, and prohibitive underwriter fees is entirely bypassed. Investors gain direct, transparent access to real-world assets. This model operationalizes capital on demand. Junior miners can secure funding precisely when they need it, successfully bridging the valley of death to complete their geological exploration. The stakes extend far beyond corporate finance. Building the infrastructure for the energy transition requires a massive, unbroken supply of copper and lithium. Real-world asset tokenization replaces an archaic, paper-bound system with an automated, cryptographic data flow. It democratizes access to global liquidity, ensuring that the critical heavy industries of tomorrow have the capital they need to build today.